Hey guys, Mike here. So obviously the big question in everybody's mind is, are we at the bottom? Are we at a bottom? Are we even near some kind of bottom, right? Will there be green in my future soon? And so, I'm going to show you 3 indicators and then add one onto it as well that can kind of point to where we're at. Nobody can time the bottom. No indicator can tell you that. No person can tell you that, okay? But these are things you can use, tools you can use to, if you're a person who dollar cost averages in, to get you more bang for your buck, okay? And so you're not buying at the top, you're more buying down in the middle or the bottom, okay? And so, we'll go through those. I'm also gonna show you a list that, if it don't blow your mind, I'll be shocked. It blew my mind because one of you guys sent it to me, and I was like, whoa, my goodness, and I verified a bunch of them, so I feel comfortable with it. But it is amazing, this list, to see the damage that has been done to so many companies, okay? And, understand in this market, again, not financial advice, no telling what's going to happen because you got stuff going on with Russia right now. And I just want to touch base real quick. I told the members this morning, but understand the Russia thing is a big deal because if it does go to war, it's not the war that's going to freak the economy out or anything like that. Actually, economies actually do pretty well during war. It's what Russia provides to the world, right? They provide a lot of oil, a lot of natural gas, especially to Europe, right? But more importantly, also, they provide like 25% of the world's wheat demand and then meet about 20% of the world's corn demand. And so if they end up going to war and those distribution avenues get blocked or whatever, we put sanctions on them and stuff like that, then, you're talking about, food prices just going through the roof, right? I mean, and energy prices are already going to go through the roof, and that's going to raise everything else up. And that's the last thing we need, because if you hadn't noticed, we already got high inflation, okay? And that'll just continue to draw this out even more. And so, hopefully that does not happen. Hopefully they're able to avert this whole thing and more people don't get hurt and all that good stuff. I'm hoping that's what happens, but we'll have to see, right? It's like a big game right now. So anyway, if you're getting out of it, hit the like, subscribe button for me, guys. If you do hit the subscribe button, make sure you hit alert and then hit all right there. Some of you tell me you're not getting the alerts for the videos. Try that. Let me know if that helps. Send me an email, hit me up in the comments, whatever you got to do, okay? And so let's go ahead and get into whether or not we're at near a bottom or near the bottom or whatever, okay? And the first thing I like to look at is the fear and greed index to see where we are, see how scared people are or how greedy people are. And you can see right here we're at 29%. This fear and greed index I like to use basically tells me that 29% of stocks in the market are in an uptrend, which is not good, and are above their 6-month EMA, which is not good either. And you can see where it's at right there. And taking a closer look, if you look from January 2019 to right now, we're at 29%, and I draw a line right across from that. We've only actually been below that line right there only twice, right? And you can see right here, that was during the March 2020 crash and the 2018 crash, which was a 24% crash heading into 2019. So it doesn't get that much lower over the last couple of years, you can see. And then if we move on, you can see this right here is the put-call ratio, right? When people buy a lot of puts over calls, obviously it's a bearish sentiment. And you can see that trend line I got drawn across right there. That's when you know there's a whole lot of bearish sentiment versus when it's at the bottom. You got a lot more calls than puts, and people are very bullish. Well, if you look at the date right there, keep memorizing this date because I'm going to use it on something else. Around January 24th to around February 8th. And then flipping over to the AAI sentiment index for stocks, this is one of those ones that's almost right on the money every time. When this measures how much fear is in the market, and as you can see, we're down at the bottom. And when we hit these levels right down here, that's when you usually get a turn in the market. Whether it's short-term or long-term, who knows? But that's when you normally get that. And then looking at the VIX to see how much volatility is going on, you can see that trend line right there. We've been trending up since last June, and we haven't been below 20 in a while, which that's why I kind of believe we're not at the bottom, but some kind of bottom. And, the way the VIX is actually calculated is 2 different ways, way above my brain power. But, one is using put-call ratios somehow. And so that's why you'll notice January 24th to around February 9th, right? It's when the VIX came down dramatically. And when also the put call ratio started decreasing, more people started shifting into calls as it started coming down. And our fear and greed index as well was around 27 at that time. And you can see right there it was and you saw this major move up of almost 8.5% in 9 trading days. And so when you see a lot of fear, a lot of bearish sentiment, a lot of volatility when it's way up high, that lets you know we are most likely somewhere near a bottom. May not be the bottom, but we're somewhere near a turnaround. You can see right here, we're right at that support level once again, right there. We're down about a little over 16%. You see where 20% sell-off is. And so, you know, we're below the 300 EMA, which is not a good thing. You see that W formation is still in play though. And if we look at it even closer, you know, looking at when we've actually been below on the QQQ, the 300 EMA, you can see it was during the March crash, the 2018 crash, which happens to be those last 2 times we've been below the 25% level on the Fear and Greed Index. And you can see right there, back in 2015-16, what do you see? A W recovery, right? That's the last time as well. It's been below the 300 EMA. You see another W recovery right there. 2015, I believe that is. And something else to keep in mind as well is what's going on with the 10-year yield, right? We spiked up above 2%. People flipped out, thought we were going 2.5. But what happens is it starts consolidating, dropping down below 2%, it's hovering around 1.95%. And you can see it's way above that trend line that it's been bouncing off of for quite a while now. But the good thing is when the 10-year yield consolidates or comes down, the markets usually take a turn up. And so of course when you take all of that data into consideration, should we be nearing a bottom? Yes. Is it the bottom? Who knows? Nobody can say that. So we should get ready to see some green days coming up here soon, assuming nothing crazy happens over in Russia. We'll have to see on that, but as you can see by the charts, I mean, that's just, it is what it is. You know, nobody can predict it. Nothing's guaranteed. Again, not financial advice of any kind. And as you know, in this, sometimes my brother used to say the worst thing you can do is nothing, but in this instance, in this kind of market, sometimes the best thing to do is sit on your hands, right? I mean, don't forget we got more inflation data coming out, you know, coming up in a few weeks here. We got rate hikes coming up, all this stuff. And so, you know, but I at least want to show that to you. So if you don't use it now, in the future, you can look at that. These are very easy to find and say, okay, I can use that for my dollar cost averaging. I may even build a swing trade with it sometimes. But at least you're increasing your odds that you're actually getting in at a good time versus just, you know, putting a blindfold on and throwing it at a dartboard, you know. And so that's why I at least want to show you that kind of stuff. Again, if you have indicators you like to group together that show you whether you're close to the bottom or close to the top, you know, put them in the comments, stuff like that. And I'd be more than happy to show them to people. And I like learning that stuff because I'm always researching different types of indicators. And so, you know, I was trying to look for like what would be a good investment, good trade type deal. And, you know, when you look right here, you see how beaten down the QQQ price to sales ratio is now. I mean, look at this. We're back to 2017 levels. And it can go lower, as you can see right there. But look how crazy high we got in 2020. Doesn't that just show you, if you look at this historic chart going back to 2002, how insane valuations actually got on the NASDAQ right there. And so, yeah, we can definitely go lower, which may be what the market's trying to do. But, you know, it makes also, when the price sales ratio come down, these companies more attractive to institutional investors as well. And, you know, the good thing is, here's the NASDAQ composite performance after closing in correction territory. We've been in correction territory for a while with the NASDAQ, right? And so you can see from a week to a month, it sucks. 3 months, but it's the 6 to 12 month range, right? That's when you're going to get around 7.5, upwards of a 20% return coming out of a correction, right? And then you got the spreadsheet, which has been going all over the internet. I've been detailing this in detail for you. Breaks down the same thing just in numbers, right? And just pay attention to the 6 months and the 1 year. As far as the 1 week to 3 months, who cares? Unless you're just trying to swing trade. But, you know, looking at that 6 to 12 months, you know, you're looking anywhere from 35 to 40% returns on the QQQ. If you look down at the bottom there, between like 2018 to 2020, you know, and so you get massive returns because institutions love to buy down when we have these massive corrections and, you know, crashes and stuff. And the crashes are rare, right? I mean, we rarely have crashes. We mostly just have corrections, but it does recover. And obviously I have broken down from 2015 to 2021 pretty much for you, especially I should say from 2015 and 2018 when they were doing interest rate hikes and trying to shrink the balance sheet for the Fed. I've showed you the overall numbers look great, but there's certain years, I think it's 15 and 18, that were just a train wreck. I mean, beyond volatile, the NASDAQ and the SPY ended up down for the year in both those years. Multiple corrections, a crash in 2018. So, it's one of those things that could be happening this year. And I think it's one of those years that the market's not going to leave you behind. I can't imagine it's going to leave you behind because remember, we hadn't even begun to shrink the Fed balance sheet, guys. They're still buying bonds and mortgage-backed securities up till March 10th. So they're still increasing the balance sheet. We've had 0 interest rate hikes so far. The market's trying to price in a bunch of this stuff, right? But we hadn't been through it since 2018, and it was a really rough year in 2018. On top of all the lists, the long list of stuff that we're having to deal with right now that has nothing to do with shrinking the balance sheet or interest rate hikes or anything like that. Okay, and so I did find this one guy. I tend to like this guy. He's pretty good, but I think we're kind of thinking the same thing. But listen to what he has to say about what one of the best trades will be this year at some point in time.
Listen, I will tell you this, Sarah. I think the QQQ, the NASDAQ 100, we know 6 stocks in that index of 100 stocks make up 45% of the weight. And again, if we have Microsoft, Apple, we've already lost Facebook. If you have Alphabet, Tesla come in, then the QQQ, the NASDAQ 100 is going to be the single best trade. Forget the Ark Innovation ETF. You buy the QQQ because you're going to get these massive companies that have corrected 20, 30%, and they're going to be the leaders on the way out. But then to Mel's point, you're going to get the dozens of stocks that are truly innovative, but their valuations got way out of whack over the last 2 years, and you're going to get the benefit of them rallying 50% over a year or two. Never getting back to those prior highs, but they're going to have really nice rallies. That's how I would be thinking about legging in to tech stocks and innovation over the next 3 to 6 months as the market tries to bottom.
And here's the list I was talking about in the intro, guys, and here's what he's talking about. Not all these stocks are on the NASDAQ, some are on the Russell, and some another indice, but a lot of these are on the NASDAQ. And when you look at these percentages, they're down 93%. Rocket Mortgage down 70%, Upstart down 67%, Penn down 67%, Lemonade down 82%, Virgin Galactic down 85%, Matterport 81%, Fubo 81%, Posh 79%, Fastly 78%, DocuSign 65%, Twilio 65%, Roblox 65%, Zoom down 71%, Myrna down 71%. And that's what he's talking about. The FANG stocks, are down 20, 30%. And so as they recover, because they carry so much of the NASDAQ and the SPY for that matter, but especially the NASDAQ, you're going to have some of these clap on, the ones that are on this list that do trade on the NASDAQ. They're not down 30%, they're down 80%. So they may never reach, for years, the all-time highs. They don't have to. They just have to start recovering, right? They put on 10, 20, 30, 40%, and all of a sudden the NASDAQ is taking off. And the one thing you know about FANG stocks, the institutions have to buy them. They have to. Everybody is too highly weighted into them to let those stocks continue to sell off too much more. Right now they're down. Don't mean they can't go down much more, but when the recovery starts to happen, the FANGs are going to lead the way because they're solid companies. They have so much cash on hand. It's unbelievable, okay? God knows how many of these companies Apple could buy all by themselves. It's unbelievable how much billions of dollars in cash they have. And so, solid balance sheets, those companies aren't going anywhere, right? And so the institutions will start piling back into them when they reach the multiple they like. And then these companies who are down between 50 and 80%, all they got to do is swing 20, 30%, and the NASDAQ is just going to start to roar back, right? And obviously, the biggest question is it going to go up and then keep coming down? It might. Nobody can predict that, guys. Nobody can. That's what I was saying. This needs to be a swing trade or something you do long term. But at least with this, stocks always come back. It's going to take time. Who knows when that's going to happen? But when it does, man, we've seen this in the past. You see the charts. Every time that W-shaped recovery or V-shaped recovery, whatever it is, it happens. And so at least want to put this out there to you. And I don't know about you, honestly, that list, it's almost mind-blowing. When you see the numbers, it's like, wow. I wasn't in the market. I was in college during the dot-com bubble. But I can only imagine that's what the list looked like during the dot-com bubble, those numbers right there. And so that's stunning. It really is. That these stocks have been in correction since all the way last February 2021. That's a drawn-out bleeding correction in these kind of high valuation stocks, right? So anyway, let me know what you think down in the comments, guys, about your, which kind of indicators do you use to try to at least get as close to the bottom as you can, or how your dollar cost averaging in, and what you think about the QQQ and stuff like that. And you know what, just your thoughts for the rest of the year. If you think it's going to suck, put it in the comments. If you think it's going to be great, put it in the comments as well, okay? So I hope you have a good one, and I will see you tomorrow.